So what we're going to do today is that we're going to look at my process and a lot of the research that I found and important things that we can use going forward. But again, so I will talk about some individual stocks, say we may or may not hold them. Please do not take any of these as recommendations on anything. And also one of the questions that we got well in advance and people ask about it, and it's in the news every day, crypto. So I'll answer questions about it, but again, I'm a fiduciary, so I don't delve into crypto. I stay away from it. I stay away from a lot of things, like whatever. There's areas in the world that I stay away from. But crypto, I watch it. That's my job, is to pay attention to everything that's happening out there. For God's sakes, I think Stevie Wonder watches what's happening with crypto. But anyway, so the point is, we'll talk about it. But because of what's happening now, it all happened recently. Crypto, remember crypto.com, and it was, nobody wanted to talk about it 2 years ago, but this has changed recently with the election. It's one of these things that people call the Trump trade. So there's a lot of momentum. So part of my job is to see what's happening because it's part of our financial system. Last time when we had a market crash, crypto fell and it almost went to zero, and there was bankruptcies and there was companies doing illegal stuff. So again, that's a reason we stay away from it. But I'll leave you with one thing on crypto. Do not sleep on crypto. It's not a mattress. Bad joke, I'm done. Anyway, sorry, so let's get into it. So, but like I said, today, we're gonna look at my process specifically. What I initially always do is I zoom out. I have to look at everything. That's like the crypto, that's like China, that's like around the world. I may not like these areas, but everything is correlated nowadays. So we look at everything. So we're gonna zoom out, we're going to zoom in, and then from there, we figure out how to win. It's like a sports analogy. If you're analyzing the NFL or the NBA, first things first, you understand the rules. What are the rules of the game being played today? Who are the players? Do we have LeBron James or Steph Curry? That's important. Which president do we have? That's important. And then from there, we could figure out our offense and our defense. That's how to win, because you have to play both. You have to be able to have a good offensive game, but then if you have to play defense, how can you run and hide or do what you need to? So that's what we're going to do today. Just look at those three things from that example. So let's jump right into it. So before, again, post-election market review, I guess that means let's review the year. So when you look at this year, it's been obviously an interesting year. And one for the history books. Obviously, what happened in the summertime in June with the debates and then all the stuff that kind of happened there. But go back even further. What was happening at the beginning of the year? Everyone was concerned with inflation. Inflation was going through the roof. It had been going through the roof from 21 to 22 and then in 23. So people were concerned, are my grocery bills going to stop doubling? What's going to happen here? This is out of control. I can't afford things. So that was causing people, and that impacts elections too, because what we found out, people vote with their wallet, which is pretty interesting. And that's also interest rates. In the beginning of the year, interest rates were unbelievably high as it pertains to usually like real estate and things of that nature. So people were concerned. They were sitting on the sidelines saying, hey, mortgage rates are 8%. Should I buy? Should I wait? Should I do this? So there was a lot of focus on what the interest rates were going to do because the Federal Reserve, who controls them, they haven't started lowering them yet. So again, beginning of the year, inflation was out of control, interest rates were high, and Trump was dealing with an indictment. But that's all in the past now. Inflation's gone, Trump's president, and interest rates are coming down. So again, interest rates are very, very important. I'm going to talk about that a lot today. So much so tomorrow. The Federal Reserve has another meeting tomorrow. They're expected to decrease rates again, but that is going to stop. Like I said, they've been decreasing rates this year. There is what's called a normal rate. They're not to that yet, but they are on their way down there. And obviously, we don't have a crystal ball, but when we look at things, I'm going to talk about what I see here and what could impact the markets. Just like 6 years ago, we're about to go into, obviously, the second term for Trump. But does anybody remember 6 years ago? I obviously distinctly do, because of that was when Trump, right in the middle of his presidency, and this was the first time the markets went haywire. There was 30% volatility, meaning markets were dropping 30% within a matter of weeks. And that was 6 years ago. And that was, again, what I called Trump v. Powell, because Trump and Jay Powell had a lot of issues. And that came to head basically 6 years ago. So it's a little preview into what we're going to get into next. So now let's get into the process. Like I said, the things we're going to cover today, everyone hopefully is going to have some clarity on what it really means. Trump's in, obviously it's his second term. He can't have 3, 4, 5 terms. So this is his last swing at the bat. So maybe that means he's going to be aggressive with things. Also, he has a Republican backing. What that means is the House and the Senate. So Congress is on board with him. So that's what I said, like the top thing. If you're playing a sport, you know you have to know the rules. So the rules of the game here are, okay, we have Republicans. Typically, what do? Less regulation, pro-business, smaller government. And that's kind of happening now with all that Doge and Elon Musk stuff. Versus Democrats. Democrats are favor more regulation, social equality, and they like government intervention. So again, now we understand kind of the rules, and these are not permanent, but that's what we have right now in front of us. And then, so, okay, who are the players? Trump's first term. We know what happened in his first term, so that's going to be the core of what we go through today because it's going to give us some knowledge. But the same type of thing is that before his first term, what could we analyze then? No political background. He had a public background. He had a lot of things, a lot of business stuff that we're able to look at and review. So same type of thing. Look at his first term, look at his background, look at his bankruptcies, all these things. You have to study all of it. And then where do we go from here? Because again, like I said, he has 4 more years and he's going to put things in place. So he hasn't even come into office yet, but we know he's fast acting right now. He's appointing people like a cowboy everywhere. It's just going, and he's in the news headlines, and that's what he really does. So that's fine. So we're going to understand with what he's doing. It's important to understand he's going to be bad to areas and he's going to be good to areas. So that's the offense and defense. So I like to kind of look at that from that perspective. So let's get into it proper. The number one question that, like I said, people were asking, the crypto thing was up there, but it was basically self-serving. Are the markets going to go up? Are they going to go down? What's happening? Who's better? Black, white, Republican, this, that, red, blue, all this. You have to look at it. The stat that I came across that is astounding is this one here. So I'll let everyone kind of digest it. And if you're not looking at the screen, what it says is that the S&P 500 over the past basically 80 years. So if you look here, 1944 to 2023, so it doesn't include this year, this calendar year. It's obviously been another good year, which would skew this stat for Democrats. And then Republicans average 7%. So this is a stat that they put up, whoever this was, CFRA, is because it's 80 years. It's a life cycle. That's a person's life. So it seems like it's relevant. So it seems like it should be a good thing. But does that mean this is gospel? Or because this is statistics, does it mean it's always going to be this way? And why is it this way? That's important to look at. So my job is to pay attention to all research and then dissect it to understand what it really specifically means. So when you look at this data here, for those people that know, I'm a huge proponent of looking at the S&P 500. So that's good here because S&P 500, remember, it's just basically the 500 largest companies as like a scorecard within the US, and it changes over time. So this data was started in 1944. Was the S&P 500 the same that it is right now? Clearly not. Obviously, we're living in a completely different world there. So that's one of the things I'm talking about my process today is that you zoom out, you look at the things, know the rules of the game, but then you also have to sift through to say, okay, is this relevant information? Is this noise or is this junk? From a statistical standpoint, this isn't too important. And now let's look at it because I don't like to go back to 1944. I mean, you can understand human psychology doesn't change, but the world was unbelievably different. And let's take a look at it here from this perspective. 1944, this is just US production of oil. Just think about it that way. The top line is production, and then the other one is top line is consumption, and then you see production below that. We've always consumed more oil than we produce. But anyway, so like I said, talking about the timeline, 1944, what was the world like in 1944? You see, we were barely consuming any oil. That's because of world wars and all that stuff. But also, we didn't have the baby boom generation grow yet. So that was part of why oil consumption went through the roof. That was growing, and the middle class grew. But anyway, so look at 1944. What was life like then? You could barely use oil. For God's sakes, there was no air conditioning. Think about that. So that means the world was a completely, there was no Florida, there was no South Beach, there was no Disney World as we know it. You couldn't do that because there's no air conditioning. So the world was a dramatically different place. And my favorite thing about all this, because we're in the holiday season, you couldn't sell chocolate in the summertime because no air conditioning, it melted. So it's just, again, it was a different world. So do stats matter from 1944? Maybe, but not a lot. So let's move along again. So from the U.S. and interesting things happen. Again, from my standpoint, like I said, the S&P 500, it wasn't even actually around in 1944. It was invented because a computer was able to track it in 1957. So anyway, world is evolving. In the 1970s, it's important to understand what happened there too. We had the oil crisis, because we're going to talk about oil today, and that's why I have this up here. Things have changed dramatically, but that's one thing. We had dramatic inflation in the 1970s because of oil crisis and oil embargoes caused a lot of issues here. But also another thing happened in the 1970s that's important to the stock market and everything else is we got off of the gold standard. President Nixon got off the gold standard. Maybe he saw Bitcoin coming. I don't know, but it was for price stability. It's because of gold. When gold was back in the U.S., our stock markets were really haywire. So anyway, so just looking at this, things have changed and evolved a lot. But now in the 2000s, if you look at what I'm highlighting here, think about what happened then. That's when the horizontal drilling or fracking or the shale revolution really started. And that's important to look at because you'll see here, we started exporting oil. So we'll talk about that later as a foreshadowing. But anyway, so like I said, from a statistical standpoint, looking at all these times when the US was on a gold standard, when we didn't have a big population, we didn't have suburbs, we didn't have highways. For God's sake, schools were segregated. We think the world is separated now, but schools were actually segregated back here. So that also means neighborhoods and everything were. So again, looking at data super far back, sometimes it's helpful, but not so much so. Anyway, so now looking at how data can be skewed. I just talked about what happened with the fracking. What president was in during that time frame? Little Jeopardy question. That's one of the presidents that skews this nasty statistic that we're looking at here, where Republicans underperform. Over 80 years, we had one president that was responsible for fracking, who had the worst stock market return of any real president, basically, in our lifetime. Poor President Bush. So if you invested with him while he was in office from January 1st of 2001 to January 9th, January of 2009, because of the crashes that he saw the tech crash, he saw 9/11, markets rebound, then he had the real estate crash. So he had the worst timing of any president. So that's why, again, when you look back at this statistic that I show here, again, Republicans are losing dramatically, but this is being skewed. Bush was a two-term president. That's what, 8 years out of 80 years. So him losing money this dramatically, losing 4% because of the market volatility, that skews that statistic. So if you focus solely on politics, you can focus on the wrong area. But again, this shows Bush, Obama, Trump, Biden, their returns. But look what happened the entire time. Our economy always grew through different president iterations, 9/11s, all this different type of stuff. So anyway, looking at the statistic, it can mislead you. So we saw Bush, so we see Bush killed it for the Republicans. Now on the other side, there was somebody who skews it for the Democrats. So who was the president right before? Clinton. Let's go here, sorry. All right, so it was right before was Clinton. So Clinton had the I guess, the good fortune of basically the tech bubble. So he came into office early in the 1990s. Nothing was really happening then. The world was a different place again. If you think about when Clinton came in, the S&P 500, right now it's all tech companies. Back then, Altria was one of the big ones. IBM was a big one. I mean, cigarette companies and companies that we don't think about anymore. But the world evolved very, very quickly. So Clinton had the good fortune of having great stock market returns because of the tech bubble. And then his presidency ended right at the end of that. In comes Bush, and Bush has to take this. So 2000, then we had 9/11 in 2002. This is the tech crash. All of this is happening, and Bush has to eat all of that for his basically statistics. And then from there, but he wins the second term during this time frame. Markets keep going up, and then we have a real estate crash. And then he's out of office. So that's why that statistic you see, he lost money for his entire presidency if you had only invested with Bush. So again, this is an example of focusing on politics can lead you astray. And was he responsible for the tech crash? Obviously not. He had nothing to do with pets.com. The most famous example of whatever the tech crash, because think about it. I don't know what pets.com was. They raised 80 odd $million and they were bankrupt within about 9 months. That's hard to do, but what was the business model back then? I mean, you can't order pets online now, so what the hell were they thinking back then? And how did they spend $80 million? They buy a zoo? I don't know, but anyway, mistakes get made. So anyway, so from that standpoint, just looking at it, Bush wasn't responsible, nor was Clinton. So, but that's the political vantage point. It makes you think that they do have impacts on it. But like I said, this crash that happened here was because of subprime loans. Bush had nothing to do with them. They were started by Fannie Mae in the 1990s. So the 1990s, Clinton was president, and that's a government agency. So the statistics kind of mess it up. So anyway, or you can look at on the other side. Now let's transition into kind of looking into understanding politics don't matter that much, but we're going to get into a little bit that does. But now look here. This is Reagan. He was a two-term celebrity president, and he had an interesting second term. If you can see that, this thing that I'm highlighting here, there's this nasty line right here, if anybody remembers that. In his second term, everything was going well, Reaganomics, and then October 19th, 1987, that's one day the market was down 20%. So you see it took some time to come back. Eventually it did, but holy hell was that a bubble there. And obviously I wasn't doing what I'm doing then, but it's interesting to kind of look at how that transpired and why that did. There's a lot of research into how and why that happened. But anyway, politics, I don't believe that you need to focus on it simplistically from a zoomed out level. So like I said, when you zoom out, it doesn't matter that much, except now I'm going to give it a caveat. Where we are now, we do have Republicans in the House, and then the Senate, and then the presidency. So that's important for 2025 because what do we have coming up? Trump strategically basically put in the tax act or Trump tax rates, and they're going to sunset next year. So what we're going into next year, Trump has his backing. So, and he's acting fast, and he wants people to push things through. So this is this right here, knowing the rules of the game. When we look at next year, they're likely to extend the tax cuts or lower them or do something like that. They're going to and push a lot of stuff through. They're going to push regulation through. What is it, that first 100 days? There's always things he's going to sign executive orders right away, just like Biden's doing things on the backside now. So there's going to be a lot of headlines, but more importantly, for 2025, as it pertains to every person, the taxes, they have to get extended, otherwise they sunset. Well, I don't really think that that's going to happen, but it's important to know that this is what we have right now. And statistically, like I said, that's actually good when you have all those things because it's certainty. Markets like certainty. They do not like uncertainty. When there's a split, that's when things kind of become problematic. And when you look at, like I said, Trump's in right now, he's only in for 4 more years. But the Congress, the makeup of that, the House and the Senate, that's not guaranteed to be red for the next 4 years either, because typically what happens, we have midterms. We have midterms that come, whatever, obviously in 2 years. When I say typically, there's usually a wave that happens. It happened last time with Trump's presidency. Midway through, it went from red to blue, Republican to Democrat. And that happened for Biden, that happened for Obama. It typically, that's why midterms are set up. That's why our system is set up that way. People bitch and complain about a two-party system, but if it were a three-party, you could never have these oscillating waves in progression. It would triangulate and we would never go anywhere. So anyway, so from that perspective, but if we do have that, like I said, statistics don't tell you everything, but this one's interesting to look at. If we have a Republican president and a Democratic Congress, yuck. Worst returns on the board. So if that's where we're headed in 2 years, let's move on. So anyway, so let's look at what happened when Trump came in. So what we're going to do now, this is analyzing Trump's first term. So what we're going to look at for every single year, and this is prior to him coming in as 2016, we're going to look at the monthly market moves and basically what happened and what was the impetus for that move in the market. Because this indicates momentum. So momentum is really important in the markets because again, if you have consecutive up days, it's going to go up. If you have consecutive bad days, something is happening, and then that's when things get bad really, really quickly. So when you look in day by day, obviously you can see the momentum, but again, don't zoom all the way out or zoom all the way in. From this perspective, it gives us a good monthly basis, a good momentum chart. Anyway, 2016, I brought it up here. This was Obama's last year, but we do know that Trump won the election here in the fall, and there was a little bit of a Trump run up then. So in 2016, even though he had no political background, nothing, but people looked at his business background, he's going to be pro-US, but also he had Republican backing. So he was going to be able to push his agendas through. And again, like I said, we know what Republicans typically look at. But anyway, so 2016, kind of funny, ironically, that was the last normal year the markets have had prior to Trump coming in president, or actually statistically for like last 50 years, because the average return on the market is about 11% or 10%, whatever. The total return for this calendar year was 11%. So it's the last time we've really had a normal time. And again, when you look at it, you'll see the rest of the years that come up, this is relatively normal. Half of them are roughly up, half of them are roughly down, and not too much of a dramatic swing. But like I said, now enter our new president, Donnie. Donnie introduces volatility because that's what he does. So now let's look at his first year. First thing that stands out to me, that's a lot of green. Nothing else here, really. So again, market momentum. This year, the market momentum was good. It was the first year, honeymoon phase. He came in here. When you look at it for initially, right when he got in, he got appointed. What was he talking about? He was talking about tax cuts because now he had the Republicans behind him and he was going to say, okay, I'm doing tax cuts. And he talked about personal and he talked about corporate. And the corporate one was long lasting. The personal one was the one that sunsets. So anyway, it was kind of like, hey, well, things are going to look good. So that's why this is atypical. You do not normally see years like this. So again, when you looked at 16, that's again more half and half. And statistically, I don't remember the exact number, but it's roughly 54% of the days in the stock market are up. That's it. It's like a casino. Casino wins what, 55% of the time or something like that, depending on the game. The stock market's not much different, but it wins over time. So when you see this type of thing, it's atypical. So that's when you see things running up, but then they have to calm down eventually. So anyway, but looking at the kind of what happened here, like I said, there was optimism early on. In his first 100 days, if you recall kind of what happened, the one issue that he kind of ran into, there was the wall stuff and a bunch of crap. But the one thing that happened was Obamacare. He had a little bit of an issue with Obamacare, trying to get rid of that. And the changes were there, but we know that it didn't go away. It went down to the states and things of that nature. But that introduced volatility because of 2017 was an atypical year. You see, it was just like a linear shot up like that, except for a couple hiccups. One of the hiccups was what Trump had to deal with the Obamacare thing. But he got past that. He had to be on obviously good behavior. He's trying to push things through. Another thing happened in the summertime that caused volatility. It's more than this because again, there's just the end shakedown, but there was a pretty good drop there. And we're probably going to see this again because the government debt ceiling always comes around in this time frame. And this was Trump's first swing at the bat. And what was he talking back then? Drain the swamp, drain the swamp. I don't think he did it, but anyway, so that's who he does. He has rhetoric. So there's a hell of a lot of that rhetoric right now because again, Elon's going to come in and cut the government and hack and blah blah. That's the rhetoric. But anyway, it's going to come up in play. So next year, you better damn well believe people are going to be concerned if you work for the government, or there's going to be cutbacks, or it's going to be harder to get it into the government. That's probably the reality of it. But anyway, that's going to be on the headlines next year. So if the Trump's year repeats, maybe it's a good year because he's going to be talking about tax cuts and things of that nature, because we saw how 2017 looked. And you see this momentum here at the end of the year, because that's when the tax cuts actually went through. They started to go to the House and then they went to the Senate. And then December 22nd of 2017, Trump had passed the tax cuts. That was for corporate and individuals, and the individuals were for 8 years. I guess he saw this coming. So now he gets to kind of deal with this again. So anyway, that's where we were. So he passes the tax cuts. This was not his best return year, but it was by far his best momentum year. It was a really good year. So his first year felt good, was all good. Now, 2018, how does it look? First thing I want you guys to focus on or notice here, let me go back. So in 2017, all positive and -1 to 4. That's a pretty small scale. Now look at this one, 10 to -15. I think that's a bigger spread, right? So what happened in 2018, volatility came back around. And it came in a lot of different forms, but it's just like whatever, a storyline. There's a few villains in there. That's just how the market works and things that kind of disrupt the markets. But anyway, so the volatility really kicks up in 2018. So it's a year after Trump's in, the volatility starts to come up. There's still the run up here. You see, this is a great month here because this was right after the tax cuts passed. But I alluded to it earlier, and it's really important what the Federal Reserve and interest rates do. If anyone remembers, if they're a nerd like me, what happened in 2018, February. Enter Jay Powell. That's when he got appointed. He came in, replaced Janet Yellen. Janet Yellen was the head of the Federal Reserve for a long time, and she did not do anything. She kept interest rates low for a long period of time. Jay Powell comes in immediately. He says, oh, tax cuts, all this going, more money into the system. I'm going to look at increasing interest rates. I'm concerned with inflation. Out of nowhere, because again, that's just how things work. Anyone can understand if interest rates are higher, that means profits are lower. And he said, hey, I'm going to push interest rates higher because something is wrong here. Off the break, that's what he started doing. So it caused a disruption to the market and things kind of corrected here. And then things kind of settled out throughout the year. Again, you kind of get the momentum, but that's the markets correcting, saying, oh my God, what is going to happen here? And how long is he going to be doing this? How long he's going to be raising rates? Because there is no precedence for this. Markets like certainty, and this was an uncertain thing because there's no precedence for him coming in. And also, he's an attorney by background. He's not an economist. He's not this. So he just comes in and he's saying he's going to do all these things, cause a little bit of chaos. So that's in the first part of the year. But then what happens in the fourth quarter of that year? I talked about it at the beginning 6 years ago. The end Christmas time of around 2018 was nuts because the markets had been going haywire for a while, and it started there in October because that's the midterm, right? The House had moved back to being Democrat, so Trump didn't have all the support so so for whatever reason, people voted the other way. So that meant probably in 2020 it was going to go to a Democrat. That's just kind of how the momentum happens if you kind of track political. But anyway, so that happened and that disrupted the markets there. And then in December, if you guys remember, this is when it really got hot. Trump was actually the first time ever, he was going after Jay Powell, saying he's raising rates, he's killing the economy. He was tweeting, he was in the news, he was doing all of these things. he was commenting. That's what he always does. And the Federal Reserve was actually going a little bit more aggressively than they should. But also a trade war. This is when Trump introduced the China trade war at 2018. He said, hey, I changed corporate taxes. Now I'm also going to put tariffs on, the trade war is going to start, and a lot of things started to happen after that. The markets corrected, and it was a dramatic downturn. So if you close your eyes and think about it, within a matter of weeks, the S&P was roughly 20%, NASDAQ like over 30, small caps 30%. So that's a big drop off that we have. So like I said, volatility came back into play in 2018 in his second year. Part of it was his own doing with the election. Part of it was his own doing with the trade, and then the Federal Reserve causing an uproar. And you can say that's his doing because the Federal Reserve, they're operating to say, hey, we need to make sure inflation doesn't get out of control. So 2018 was a very volatile year, in his worst year from a return perspective, but volatility got higher and higher, as you guys remember, because of 2020. But so now let's look how things rebound in 2019. It was pretty interesting. Right away, like I said, after that, the Federal Reserve kept raising rates. Immediately in January, they came out because the markets had went haywire. And they do have to react to things, just like a politician has to react if the people go nuts. And the markets had spoken highly to say, hey, Powell, you're going out of control. He immediately came out and said, we're going to stop cutting rates or stop raising rates. And in today's world, that's unbelievably important because when there's a trajectory of things, when things are going up, the algorithms know that. Just like tomorrow, the Federal Reserve is going to expected to cut rates. We're in this trajectory down right now. But what happened? We were in this trajectory up, and then the Federal Reserve said, we're going to stop. And interest rates were higher than the market thought they should be. So what did the algorithm say? Okay, it's a matter of time before they're stopped, and then they're going to go down. That's the next direction because they've peaked. So that's important for stock valuation. So anyway, things started to rebound there. So in 2019, the Fed again came out and capitulated to say, hey, we are being a little bit too aggressive. Maybe inflation's not that rampant. We can calm things down. So the market started to rebound 2019, but we did have volatility come back into play. And if you look at what happened here, and you can look at kind of why this was caused, May 5th, if anyone remembers, it was an important day in 2019. Trump tweeted out $200 billion of tariffs on China. It wasn't important economically because right after that, China said 60 billion. It was an offset, this and that. But we never had a president doing that. We never had anyone going to Twitter to announce policy on trade and tariffs. That wasn't how things were done. So it's like, was he out there to pick a fight, or was he leveraging the media, or what the hell was he doing? Anyway, it caused market downturn relatively quickly, but then things bounced back here. Because again, China announced their tariffs, and it was a net win for the US. And also at this time, very importantly, like I talked about, the Federal Reserve actually started cutting rates. Here they said we're going to stop raising, and then by this point they had started cutting rates again. So then things kind of get normal again. The markets are in good order. The tariffs didn't cause crazy inflation. The Fed said inflation's not out of control. Things are all normal. End of 2019. And then something happens. Then we go into 2020. Then it gets crazy, obviously, right? So think about it. So this is going into Trump's last year. Things were really, really good. The markets were at a good point. Inflation was okay. The interest rates had moderated, and the markets went through a cycle, and they're going up. They were at all-time highs. They were at all-time highs, and that's what happens. When they're at all-time highs, they can also violently go down. It's the same exact thing when things are bad. When the markets have went all the way down, they're going to come back violently up at some point. Whatever that impetus is, it's going to happen. So this was the opposite side of that. It scared the hell out of the whole world, right? I mean, COVID, we all lived through that, and we all remember that. Time-wise, markets are at a high at the end of January, February 13th. Anyone remember the day? That's when we had 15 cases announced by the CDC, and it was mostly in Seattle or whatever, these cases coming through. And it's like, okay, now it's out in the air. And then you talk to a scientist or whatever, said, okay, now you can't stop it. The toothpaste is out of tube or whatever the hell you want to think about, is that it's in the air. And now that we know, whatever X amount of years later, it's like the cold. Once it's in the ether, it stays there. It gets dumber and weaker with time, because that's that's what has to happen. It can't get stronger, because otherwise it wipes out entire populations. And that was the one thing people were concerned about, was that what is this going to do? Is it going to take out populations? And that's a problem. That's why the markets went down 35% or 34% in weeks, because the CDC on February 13th announced the cases. March 15th, states and schools close. March 23rd, the market hits a bottom. So February 13th to March 23rd, markets go like this. What is that, like 4 weeks or whatever? Like 30-odd%, because there was assumption that there was going to be a mass amount of people dying. Obviously, tons and tons and millions of people died around the world, but the economic component of it, the age, young people didn't get wiped out, and none of the working age population got worked out. So our economics, so when you look at the GDP, none of those things got disrupted. So that's why the markets rebounded quickly. And what the fascinating thing that happened was the social adoption, what people got used to during this time frame, just like what we're doing now. People got in touch with Zoom. Now you could work Zoom from home. It became normal again. Personally, FaceTime, like my father, he's a dinosaur. He doesn't even have a cell phone. But during this time frame, he has grandkids, and he wanted to see his grandkids, and people started FaceTiming. So people adapted technology on the work side and then on the personal side. Same thing happened online. I mean, I'm right next to a mall here. It used to be different in 2020. People used to go in, and when I was a kid, going to the mall was a fun thing. But now it's crazy. People go to a store, sit on their phone in their car just to get somebody to bring out the stuff. It's like people are getting more antisocial now because of its creatures of comfort. People want to do things just like now. You're logging in from home. We didn't have anyone come up here. It's easy. Technology makes things easy, and people adopted that really, really quickly. I mean, Uber Eats, for God's sakes, they can deliver McDonald's to your house, which is a hilarious concept to me. But anyway, it's just a turnover what happened, and it was in times of peril. Things evolved, but these rails were there. Zoom was there before all of this happened. All these things were there. We just adopted it. So it was interesting to see. In the S&P 500, as I talk about, it used to be different. What it is today in 2020, it was an atypical year. Usually S&P 500 has, of the 500 companies, very few fall out. But in 2020, a lot of them fell out because AMC used to be in there. Bye-bye. Where do kids go now? Where does Netflix? Everyone's on Netflix. Everyone's on their phone. So AMC used to be a big deal, not anymore. And also, some kind of cool is that, so Sears used to be here, Macy's used to be here, they fell out. Sears was the first Amazon of the world, basically 80 whatever it was. They came out with the Sears catalog. It was the first place you can buy clothes, refrigerators, tires, everything. It was the first Amazon. And the funny irony here, or whatever the hell it is that Amazon sent our house, because we're Amazon Prime, Platinum, Gold, this, that member, how much money we got them spend there. They sent us a catalog, like the old Sears catalog of Amazon. And my daughter, 5-year-old girl, bless her heart, she marked up every page, circling things that she wants. Because that's what people are longing for that nowadays. But again, it's just like how things have evolved quickly, but it's still the same thing. People just want to have chocolate on the holidays and spend time with their friends and family. But anyway, so a lot of things happened in 2020, but as you see, the volatility. So was it Trump's fault, this fault, that fault? I don't know. But what's interesting from my side is that the markets always go forward. People adopt. So if we can't work, we're going to work from home. If we can't go to the movies, we're going to watch at home. If we can't go to the restaurant, bring it to me in the car and we're going to eat in the car. We are social beings that need to consume. And that's why there's that statistic. The US is 70% consumer based, because that's who we are. We consume over time. So again, that's interesting when we look kind of back at COVID, what happened there and how things evolved. So that wrapped up basically Trump's last year. So now let's look at the synopsis or the summary of really what happened there. So the 4 years, there's green and there's red. So green obviously indicates good. So he had 3 good years and 1 bad year, but the hell of a lot of volatility. Even in the years that are green, like 2020, before it got back to green, it was down 35%. So there's years where there's dramatic ups and downs, but holistically, things went up over time. But so again, what this is the US. This is just not a specific investment, except for it's the US stock market. It's Vanguard's total market. So in the US, it's all 3,000 plus stocks of the market. So it's not saying that one specific area did well, but the US did well over Trump. International did well, China did well. They all relatively did well under Trump. But so there's one interesting thing if you look at 2017 that I found, and I'm going to pose it to you guys. Who do you see anything interesting here for 2017? Trump's first year. So we're talking about the Trump trade. We see Bitcoin going up right now. Tesla's actually doing better than Bitcoin statistically since Trump came in. It's day to day, but anyway, both of them are going through the roof. So the Trump trade now, Tesla's doing well, Bitcoin's doing well. Obviously, disclosures. I stay away from Bitcoin. Blah blah blah. 2017. What was the Trump trade? Which did best? China. Trump talks trash about China, but Trump trade 1.0, the first thing to bet on in Trump's first year, China did the best, which is kind of a funny irony, because after that he put on the China trade war and all that different stuff, but he probably didn't like that because he definitely keeps score. That's one thing that he does for certain. So anyway, the other thing that he talks about is oil. So that's what I talked about that slide earlier. Talk about keeping score. One thing happened under Trump. Really interesting. So net export. So we talked about what happened with oil, the shale revolution, and we started producing tons and tons of oil. You see this net export number. There's this 2020. 2020. That's when it was the first time the U.S. ever in its history had exported or net imported oil. So we were producing more than we're consuming. And that's really, really good. So does that mean we should invest into oil? I don't know, because during Trump's first term, oil energy did not really do well at all. But oil, us producing it and exporting it, it's really good for businesses, price stability. Think about like an airline. That's the worst thing that they lose sleep over is that over gas prices, and they consume the hell out of gas. So if gas prices go up or down, it's a problem for airlines. So now if we have price control on oil, that's good for airlines. Again, I don't like whatever, I'm not going to talk about airline stocks, but just think about it that way. It's good for businesses. We have price stability. Personally, do you want to buy oil? Whatever, we're not going to talk about individual stocks, but we're all winning. Look at gas prices. I don't care what the country songs say, gas prices high. No, gas prices are low right now. So that's how we're all winning. And they're going to stay relatively moderate because, again, right now we control the price of gas more than we ever have in the past because we're net exporting. And it's also good for national security, right? We don't have to rely on anybody. In what happened in the 1970s, all that scrambling. If we're producing more than we need, it's really, really, really good for the U.S. So that's a real positive. So now let's look at the rest of the world.
We've just changed slides. I just want to give a quick reminder. It is nearing the end, so just time check for all of us.
Yeah. We're about to go. So cool, thank you. So anyway, so the production. So here, like I said, the U.S. has been producing more oil, as you saw there on that slide. But the number one thing I wanted to focus here on, we're starting to zoom in too much, figure out how to win. This is the last 2 slides I'm going to get into. India and China. You saw our production or our consumption is basically staying the same, and here are the numbers to it. Our consumption has not grown. It's 0.5 annualized. But look at China, it's basically 20%, and India is close to 20%. So those areas, they talk about emerging economies, they need oil. We produce oil, we export oil. So like I said, it's a good thing for our economy, but does that mean do we invest into it? So last slide here. Because again, I talk about the S&P 500. So actually, let me pull up this one. So it's the S&P 500. So this is the constituencies of the S&P 500. So energy is only 3.2% of the S&P 500. That's good because that means our economy does not rely on energy. It used to back in the day, many years ago, we used to rely on energy for a lot of things. And like I said, that's what caused the issues in the 1970s. But now it's a small piece. Just like our wallet share, it's about 3% of a person's wallet spend every single year. So from an energy perspective, again, it's not where our economy gains value. The number one sector in our economy right now is technology. That's what I just talked about, like Amazon. What do? We use our phone, we use our computer, we use Zoom. And that's what the US has a hold of right now. So anyway, so the last thing here is that, like I said, talk about winning the Trump trade. This line here that I'm highlighting, it says quarter to date. So what that means is from October 1st to December 13th. So that includes October, November, just before elections and elections. So if there's any run up and any kind of run up after, where it's about Trump momentum or something like that, look at what's done well. Energy has not done well. The biggest losers here, if you look at it, materials have not done well. Real estate has done poorly. Healthcare has done poorly. Utilities have done poorly. So this is zooming in momentum. Like, is this a real thing happening or just turnover? When you zoom in, ultimately, okay, are we trying to play defense? Are we trying to win? What is really happening under the hood? What's doing well? Financials. Bitcoin is a proxy of that, but consumer discretionary, that's doing well. That's Amazon, but that's also Tesla. And we know Elon is buddy with Trump right now. Tech is doing well in communication services because these are areas that we use. Like I said, that's the Netflix of the world. That's our cell phone, and everyone knows what technology is. So anyway, so those are areas that are doing well. How to play offense. So you really need to understand, what is Trump going to do? So I'll wrap up here because we are on the tail end, and I want to leave some Q&A time. To reiterate, so that I got back to that side of how to win. Sorry. How to win, we need to know how to play offense. So like I said, what I started off with, Trump and Republicans in control. So we know he has 4 years and it's going to be very volatile. That's going to be the case, and maybe there's a midterm shakeup coming around the corner. So kind of understanding that. And what is he going to do with his tax policy? Is it going to be good for you, bad for you? So as it pertains to taxes, you don't have to update anything January because the tax law is not going to change until 2026. So it's important to pay attention to it because it's going to be in the news headlines. So is it going to keep the markets going up, or we'll see what happens. Trump's first term, we saw kind of what he did. He has a theme that he does. He's going to cause volatility, but holistically things went up. Where do we go from here? Hopefully they kind of keep going up. But if you look at his term in, let's just say 4 years, there was one bad year. Is it going to be a repeat of that? History doesn't repeat exactly like that, but it might rhyme. Maybe it's a movie backwards. Maybe he starts with a bad year and it gets better, or whatever the case is. But it's statistically, I doubt he's going to have 4 perfect years, because that would be 6 perfect years of stock market, and that's not how things work. So anyway, so it's just understanding kind of what's coming around the corner, but don't let the political viewpoint kind of mess you up. But anyway, and then where do we go from here? We'll talk about that more. I'm going to stop so we can open up for Q&A. Valerie, if anyone's raised their hand, or Valerie, you can go.
Awesome. Well, thank you so much. That was very helpful and informative. And with a lot of information, typically comes some questions. So as you said, now is the time for any questions that we might have. So the way to ask a question is, please use that digital button. It should be down toward the bottom of your screen, and it's a little hand, and it says raise hand. As hands are raised, I will be able to grant permission to whoever is raising their hand and allow them to speak so they can unmute and ask their question. So go right ahead. We're going to open it up to Q&A right now. And just remember, if you have a question, someone else might have a question too of the same sort. So you are doing a great service by asking that question. People are probably looking through all their notes right now, determining, oh, which question should I ask? So we did have a pre-submitted question. So I will go ahead and ask that as everyone's figuring this out. Something that we got asked, how often should I be updating my investments and do I need to update them right now? I know you just touched on that a little bit, Verdi, but if you could expand a bit more.
Yeah, so I mean, should I update them now? My viewpoint is that you always need to be updating them because, like I said, the world is evolving all the time. So as we're like, you can kind of distinctly hear, we're looking at them every single day. So this easy answer is if you haven't made an update in a long period of time or at all this calendar year, you should have. And there specifically, as we're turning into next year, you should understand what the theme is for that year and what you're investing into. So updating investments as a general rule of thumb, I'm a huge proponent of doing it a few times a year and also understanding your trajectory. And as always, the disclosures, risk tolerance and time frame and all that. But yeah, you definitely should be updating them. And also things are changing. Just like when Trump 1.0 came in, the thing that really was important is that he changed US corporate tax law. And that changed things for again, that's indefinitely. So is he going to do something like that again next year, or is he just going to extend it, keep things the same? So again, as it looks at 2024, there are updates that should have happened this year. As I look next year, something is going to happen, and you're going to need to necessarily update and kind of react to that. So yeah, I mean, maybe I'm biased, but you should be looking at it proactively. Yeah.
Awesome. Thank you, Verdi. Okay, I see a hand up. Dwight Pearson, I'm allowing you to talk. Please go ahead and unmute and ask your question.
Yes, Verdi, you had mentioned that during the first Trump administration, he threatened tariffs against China, which ultimately benefited China. But my question is, with all this talk about tariffs, is it potentially too soon to actually adjust your portfolio because we're not quite sure how seriously he's going to go at those tariffs, if at all?
Justin, so can you expound upon that further? So the reason is that simplistically, the markets are always looking forward. So uh, the debate is 6 months, 12 months, whatever the case is. So that's why the markets are in a really good position. They've been running up for the last 6 months. I talked about momentum. That Trump's first year was 10 of 12 months were positive. I think this year it's going to be the same exact thing. It's going to be 10 of 12 or up. Last year was the same thing because of the Fed started decreasing rates and they're going to stop. So that's on the agenda for 2025. So that's a volatility inducer. Now the tariff thing. So are they going to come around the corner? So like I said, the markets may understand that he has this in his agenda there. So then it's again, are you trying to bet on, so to speak, something specific? So like I said, what are the tariffs? So are you saying the tariffs are going to cause inflation or they're going to cause the market to go down? So do you need to basically combat against that? But if you're still unmuted, did that cover the question or do you want to expound further?
Well, I guess what I'm saying is that it seems to me there's so much uncertainty regarding the tariffs and what potential impact that might have on the economy and the stock market. It seems as though it might be prudent to have a wait-see approach before you do anything. So I would wonder how you feel about that in terms of just waiting to see what if what does he actually implement during the first, 100 days
Yeah. So
before you start adjusting your portfolio?
yeah. So my viewpoint there, this is a little bit strategy, and I don't get too deep into it, but it's easy on the sports level. So if I know I'm playing against LeBron, or Steph Curry, we know what they're gonna do and what they're bad at. So if Trump is gonna pick a fight with China, or if he's gonna pick a fight and cause tariffs and inflation in this area, if there's gonna be a fight over there, what I do, just stay away from that area. So like I said, that's the defensive side. So it's like, again, from the sports standpoint, if he's always going to do that, we have to kind of offset that. So it's like, I'm not going to, I don't like to delve into that. Same type of thing is that, so like when you look at crypto, because it's a black box, it can go overnight and cause huge issues. And that's the debate about like China as an example, how they operate and also their reliancy of the real data that they send out. Is that so you just kind of stay away from it. So my vantage point is if you're concerned about it, just don't go to that party because there's an issue there. But if you're really concerned, I mean, but the tariff thing. So Trump is also unbelievably self-serving. So if he's pushing tariffs through, this is a guess, a belief, or whatever the hell you want to call it, is that I don't think he's going to do it to kill himself. So that's from that standpoint. But if there is tariff talks, like you said, that's why I went through the monthly thing. God damn it, the markets react to it, and they react quickly. So yeah, I don't know how much more I can say there without getting too specific.
Well, thank you very much. I'm going to give it one last call for any questions. If you do have questions, please go ahead and raise your virtual hand right now. We'll give it a 10-second wait, and then if not, we are starting to wrap up right in the nick of time.
So if it's a question popping through, if not, we're good to go to cut because I have.
Yeah. Verity, that means that you just did such a great job explaining everything that no one could even come up with additional questions. So, well, that's that. I'll go ahead and say it right now. Thank you everyone so much for joining us. There will be a little survey right after this. We really encourage you to fill out that survey so that we can help improve our content for you all and go ahead and schedule a meeting. But thank you everyone and have a wonderful, wonderful holiday season.
Thank you.
Bye everyone.